I'd like to welcome those of you who are logging on now and do give us a few moments. There's quite a number of people who are registered for tonight, so we're going to give them ample time until the top of the hour to get on board. But I appreciate, this is Jim Kenny. I appreciate you here, and get a pen and paper if you could to take some notes on what we talk about, and get comfortable, and we'll be getting started around the top of the hour. Okay, as the people start logging in here and linking up with us here, I did want to ask the new people that have just come on board here that if they could get a pen and paper to take notes. I think that'd be very helpful because we're going to go over quite a bit of information tonight, and we'd like you to get as much out of the webinar as you can. So please get a pen and paper so you could take notes, and as you listen along, maybe write down questions you might have that are coming up and confusing you. Okay, so nice to have you with us here, and we'll be starting again right around the top of the hour. Okay, for the people that are just checking in now, again, I'd like to welcome you. This is Jim Kinney, and we will be starting up in about 5 or so minutes. We did have quite a large number of people who registered for the webinar, so we are going to let them have access to getting on there and get going as quickly as possible near the top of the hour in deference to the people who showed up on time. As I was saying a few minutes ago, if you do have a pen and paper handy, we will be going over quite a bit of information. You probably will have questions, so rather than just trying to remember them off the top of your head, it's probably good to write things down. And we'll try to get to them here today or after the meeting. Okay, but thank you all for coming, and we'll get going here before you know it. Thank you. Okay, as we get towards the top of the hour, there's always a rush of people getting online here, so they are coming in pretty fast and furious as we speak. So let's give these guys a few minutes. I am going to start out with some polling questions so I can get some idea, or you can ponder some of the things that you have an interest in, and then either after the broadcast or tomorrow, we might be able to get into more details on some of the specific questions that you might have. So do get ready for some polling questions that are going to come at you. There's only 3 of them. And basically, we'll try to get to some of the areas and questions that you have an interest in. As you can see, we do have a PowerPoint presentation, so I'll be going through some slides as well. And again, we'll be going over and giving an idea on how you can get more complete information on everything that I talk about. In this brief meeting, obviously, we cannot go over all the areas and all the different things that need to be gone over in such a short period of time. So some things we'll be going over briefly, but you'll be invited to get into them more deeply if they strike your fancy. Okay, we're right at the top of the hour, so this is as usual when quite a number of people just join in. So we will be starting momentarily here, and I do appreciate you guys coming today. So I'll try to give you as much information as I can, and hopefully give you some things that you are finding informative, and hopefully some of the things that might be of interest to you as well. So I do appreciate everybody being here today. And since we are past the top of the hour, I am going to get started here in fairness to the people here who all got here on time. Okay. By way of introduction, I'm Jim Kinney, and I'm the branch manager for High Ridge Futures. HRF is an introducing broker, and HRF has a clearing relationship with ADM Investor Services, which I will discuss a little further at the end of the broadcast, at the end of the webinar. Okay, a quick background on myself. I'm a graduate of Boston College, and I've been registered with the NFA for over 30 years. I passed examinations during my career, including Series 3 as well as Series 30, which is for the branch manager. And of course, over the period of time, I have many different investments. And so at the end of the day, what this all means is that I do believe I'm qualified to explain the uses and the risks of diversifying with managed futures to qualified, suitable investors. And I'm going to begin that process as we speak. Now, what I'd like to do to start out with is go with three polling questions for you to consider, and then with your paper and pen, make a notation of where your interests are here. There are going to be three questions of a separate nature, and then I'm going to give you a telephone number that I can be reached at after the broadcast or tomorrow, where you could speak to me about these questions if you have an affirmative answer on them. The first question I have for everybody, and again, when I had experience with live seminars, obviously it's a lot easier because you're right in the same room with everybody, and you can obviously speak to everybody face to face and talk to people during breaks, etc. So with the setup that we have here with the internet, it's not quite as intimate and not as easy to communicate face to face, obviously. So what I'm asking you to do is write the phone number down that I'm going to give you right now. Have it. And then if you have an interest in these questions I'm answering, plus other things I talk about later, you'll have a way of reaching out and getting these things, more information on, and questions you might have answered. Okay. So the first polling question I have for you is how many of you are interested in short-term, out-of-the-money S&P 500 option writing? And basically short-term, nowadays could be, anything between day, week, month, 2 months or something like that, but a relatively short term till the expiration date. And then out of the money means that the striking price on the call would be higher than the current value of the market, and the striking price on the put would be below the current value of the market. And then on the S&P 500, of course, we're talking about the broad-based index of the 500 companies, which most all of you are fairly familiar with. And writing means that you'd be selling or writing the option versus the buy side. So the question is how many of you are interested in learning more or finding out more about short-term option writing on the S&P 500 index? And the answer would be yes or no. And if it is of interest to you, make a note of that, and we can talk at that at a later date. The second question I have for those of you would be how many of you are unsatisfied with the portfolio, or you maybe want to balance out the portfolio with some alternative investments, and you're open to alternative investments, which are some of the things that we're going to talk about, or I'm going to be talking about here tonight. So how many of you are open to getting more information and learning more about the alternative investment area? Okay, so if you have an interest in there, make a note of that, and then we'll again talk about that either after the broadcast or tomorrow. And finally, there are many markets out there, obviously, and some people want to actually trade contracts or options on those markets. And, they can range from the stock market to interest rates to the US dollar to oil prices to gold and silver to grains and many more. And, currently we see the stock market backing and forth after a pretty big rally and kind of staying in a bit of a range in the last short period of time here. But the long-term moving averages on the S&P are under the price and still rising. And there is a lot of, shall we say, optimism about tax reform, deregulation, repatriation potential that underpinned the market recently. So, basically the stock market is what it is. Interest rates, the 10-year note has been trading between 2.3 and 2.6. And a lot of the markets seem to be somewhat range bound lately. U.S. dollar index 102 and 99. Oil prices, they were between 56 and 53. Then they faded a little bit. Now they're climbing up a little bit. But fairly tight range in the last bit of time. And the metals, same idea, kind of range bound back and forth. And agricultural prices have a big report tomorrow. So some of you out there might be interested in those markets and might want to know about the uses and the risks of different strategies in those markets. So again, these things can be talked about after the broadcast or tomorrow if you have any interest. So do write down the phone number that I can be reached at, which is 702 873 5707. And then you can contact me. I'm Jim Kenny again, and we can get you some details on your areas of interest and see what, if any, of these strategies and markets might be right for you or suitable for you. Okay, what I'd like to do now is I'm going to go through some of the PowerPoint here, because tonight we are going to be discussing alternative investments, particularly as they relate to managed futures. And as we get into the broadcast, I'm going to go over a couple of managers that I've zeroed in on and give you some details on them and an opportunity to get full details. So the next slide I'm going to go to is the risk disclosure, which we always start out with in the beginning of any broadcast here, and will, as far as the eye can see. And this is a disclosure that goes over obviously some of the facts, which are that trading does involve a substantial risk of loss, and that these trading activities are not suitable for all investors. Very important to remember that. And also that that past performance is not necessarily indicative of future results. And I'll be saying that a couple of times more in the seminar, because as I refer to things that have happened already, we have to be reminded that that is not necessarily indicative of what's going to be happening. As many of you investors know, some things that have already happened does not mean they're going to continue to happen. So you don't want to be just looking at track records exclusively on anything, because obviously the past has already occurred and we don't know what the future holds, and we don't want to be deluded by the past to think that we do. So again, the other thing is that these trading advisor CTAs that I'll be talking about, they do have a disclosure document which goes over much more complete information than the short disclosure that I'm giving you right now. But again, that'll be available after the broadcast as well. But that's the first slide that we give you here, is the risk disclosure that everyone should be aware of as we go into the information we're talking about. Okay, moving forward, again, we're talking about managed futures here, which means a commodity trading advisor is going to be doing the trading. I'll get into what the details are, but it's an asset class. And it's an asset class that some of the slides are going to compare to the stock market as an asset class. And again, when they are talking about managed futures versus the stock indexes, realize that they're going to be using indexes and not specific advisors. And so things such as the Barclay CTA index and Autumn Gold CTA index and Barclay BTOP 50 index. These are going to be a basket of managed accounts, managed CTAs, and not any one. So the selection of your specific CTA will have obviously the effect on your particular experience, uh, not the basket of indexes, but this is for illustrative purposes only, comparing the index of the managed futures to the S&P or other stock indexes. Okay, so what we're saying here in slide number 1 is to take a look at comparing this the different periods, like the 5 worst periods of stock decline since '87, and how managed futures did on an index basis, and then your 15 worst quarters of stocks over the last 25 years, and then of course your most critical events. And we'll have a slide going on some of these things, so you'll be able to take a look at it. But how has managed futures as a asset class compared to the stock market? And you'll be maybe surprised or maybe confirmed what you thought, that uh, a portfolio diversified with the managed futures basis the index that they use has had some attractive periods of time. And of course, this is going to be a balanced presentation. So anytime you've had a good period of time, it can also be followed by a bad period of time. So like I say, you can't extrapolate everything into one thing. So anyway, we're going to go to the next slide here, and show you a little bit of information at the bottom there that's very intriguing, because many of you have no investments in this at all, or maybe have not even looked into it. This idea of having an advisor do a certain strategy and a certain methodology and work with part of your capital. But there are people who have participated in this in the last 15 years. Now there's a statistic that kind of opens your eyes. Over the last 15 years, total assets invested into managed futures have grown by 771%. That's more than it took to grow in the previous 20 years. So there's been an acceleration a bit in the last 15 years of money flowing into this asset class. And I think it's kind of interesting to take a look at that, because again, as an alternative investment strategy, it has attracted capital. So this is something that you may not be aware of, but certainly other people have looked into the strategy as an asset class. Turning towards what is managed futures, let's get a definition in front of you so you can start getting it around your head how this works. And again, I am going to go into a couple of specific managers, one who deals with E-mini S&P contracts, and another who works with proprietary models on trading contracts. So I do want you to remember that we are going to be going towards that area as we go through these slides, okay? But first, for the people who have no information on this, it's important to know what we're talking about, obviously. And managed futures is one where you have a registered CTA given responsibility to make all the trading decisions. He's got a authority delegated by the account holder, which is a limited power of attorney that can be withdrawn at any time, but he does make all the trading decisions. That's why you're hiring him, because you're looking at that strategy that he's doing in his disclosure document, and you are looking for somebody to diversify your holdings with in an investment that may not have much of any correlation to the other investments you have in stocks and bonds. Turning towards this, though, you can see that the CTAs are regulated by the NFA, and they're registered with the CFTC. So these are regulated guys, and they are registered people, and they are managers using instruments in the commodities markets and the options market on the commodities. Okay, so that's what they're all about as far as their licensing and all that kind of stuff. Okay, let's go to the next slide here, which is the growth in the industry we talked about. There's a chart that kind of puts it in light. And as you can see, money has been flowing into this asset class in a fairly dramatic fashion since the turn of the 2000 timeframe. So right after, looks like right after the big drop we had in 2000, people started to diversify into this in a fairly large way. And that growth has been obviously very, very dramatic as far as this chart is concerned. That's where you get that 771% growth in the last 15 years. That's what it looks like in chart form. Okay, so as an asset class, this has been growing, and again, one of the reasons, among many reasons, would be that people want to diversify with something that's not tied to the stock market having to go higher, or the bond market having to go higher for them to see some appreciation potential on their money. And then, of course, that if those assets like bonds or stocks have a time where they're not performing very well, they have something in their portfolio that might be able to bring them some potential performance because it's not linked to those two markets necessarily. Okay, so that gives you a little bit of information on that slide. I think that's kind of interesting for people who are not aware of it. Let's go to the next slide here, and that is the growth of the futures industry again. This is quantifying a little bit here, that in 1980 you had less than $1 billion in managed futures, and in 2000 it was 37 billion, and then by the end of the first quarter of 2015 you got 330 billion dollars in the managed futures asset class. So again, this is just evidence that money has flowed into this asset class, and you know, it's for suitable investors only, and it's for an investment for a certain people, but it's certainly not right for everybody. Let's go to the next group here, and they do say that according to Barclays Hedge, one of the oldest and most respected providers of this alternative investment data, out of the $1.78 trillion invested in alternative investments, managed futures is now #1, surpassing all the other investment strategies based on assets under management. AUM, I think sometimes they use as a representative of assets under management. Okay, so we're going to go to the next slide here, and that's again indexes that they've put together. And studies. This study here is a kind of a landmark study by a late Harvard University professor, and in his study he concluded that with managed futures, it's potentially going to be able to increase performance and reduce risk in your overall portfolio. Again, I alluded to that if it's not correlated exactly to the stock market or to the bond market, and it does have decent performance while the other ones might not, it could potentially smooth out some of the performance ups and downs and reduce risk in the overall portfolio. Again, past performance is not indicative of future results. So again, this is just a study, and this is just an indicator. You wouldn't want to take it any further than that. Again, you have to look at the merit of the advisor and the guy you're working with, and you've got to look at exactly what he's doing and what his performance numbers have been, and what you think they could be before you get in there. Again, specifically who you hire is paramount on how obviously it's going to work for you. Okay, next one here again is going over performance when you have different quarters that are very bad for the S&P. And again, using an index, which is a basket of the largest trading advisor programs, not any specific advisor. So bear that in mind. This is a broad-based index, not any one advisor, and it's only a specific universe. It doesn't include every single advisor, but it does give you, again, a comparison there, and the comparison is right there for you to take a look at. And you can see that based on this index, Barclays BTOP 50 index, the performance during down times on this index has been reasonably good compared to when the stocks have their 15 worst quarters. So that's a little bit of information there to take a look at. The next one here is going to be on CTA returns during periods when the S&P lost 10% of value in a quarter. And again, using the Autumn Gold CTA index, so the broad-based index of many CTAs reporting to, again, it's a limited universe. It's CTAs that are reporting to the Autumn Gold database, but it is a index, and in this comparative study, you can see that during the worst quarters, let me just double check there. No, when you lost 10% or more in a quarter, I'm sorry, since 1990, the green is the Autumn Gold CTA index, and so that's where they're getting the concept that the asset class of managed futures can sometimes be something that can smooth out the overall portfolio risk. But again, it will be dependent upon the specific manager you hire and his specific results. This is just a comparative study, and realize again that the past performance is not necessarily indicative of what's going to happen. Okay, next one is during critical events. Critical events is on the chart here, if you could look at it. Critical events include what? Well, it starts out with Black Monday, 1987. For those of you who were back doing business back there, you remember that was a very, very volatile period of time. And then, of course, you got the Gulf War. Long-term capital management lost a ton of money there in 1998. And then, of course, 2001, we had 9/11. Then we had the subprime crisis in '08, and then we had U.S. debt downgraded to AA. So we've had some volatility, but you can see here that the charts are showing that the managed futures basis the index on the Barclays CTA index did perform pretty well compared to the benchmark stock index during that period. The Dow Jones, this index is now using the Dow Jones as its indicator. And of course, for the managed futures, they're using the Barclays CTA index. Okay, turning to the next graph here. Managed futures performance during the worst declines in history. And so again, here they're using the BTOP 50 index versus the S&P. Now, again, the S&P is not indicative of every single stock in the universe, and neither is this BTOP 50, the Barclay Top 50 Index. But you can see, as a comparison study, the relative performance of that index certainly trumped out the S&P index during these periods of time, and there's some illustrative examples. So there you go. And turning to the next area here. The effect of allocating 20% of a portfolio, which is traditional stock and bond. Obviously, the Fed is talking about hiking rates, although yields have dropped since they hiked rates, so go figure, right? But some people have seen volatility in their corporate bond portfolio, and some of the bond portfolios that are using leverage could have specific risks looking forward. And then, of course, if there were to be some more movement up in interest rates that could negatively affect bonds, that would be interesting, because there is a lot of yield out there that has been issued at very, very low rates. And so under certain circumstances, there could be a liquidation or what they call a redemption run. Don't know if that's going to happen or not, but the potential is always there. And then, of course, on the stock portfolio, we are, 30 S&P points or so away from all-time highs again. So, the reallocation of a portion of assets into managed futures, which would have not a direct correlation as much to those two markets, is something that investors consider. And there you go, as far as looking at the effect of reallocating 20% of a combined stock and bond portfolio into the managed. Now, this is, again, hypothetical, so this is not an actual advisor, and this is not an actual stock that we're talking about, or an actual bond. It's just for illustrative purposes only, to give you an idea based on using the indexes like the S&P 500 Total Return Index, and then, of course, comparing it to different, like the TR index accounts, and then the bonds are going to be represented by the Barclays U.S. Aggregate Bond Index. And then, of course, managed futures, they're again going back to the Autumn Gold CTA Index. So these are specific indexes. Their universes are specific, so you can't extrapolate as if it's about all different ones. So you have to be realizing that while you're looking at that. But it does show a comparative study based on what you're looking at. Next thing is performance results of a 35-year study comparing managed futures and stocks. Again, they're using indexes here, and with the indexes of managed futures that they're using, you can see that the performance versus the index they're using versus the stock index they're using, the managed futures did perform quite well in comparison, and did quite a bit better than international stocks, which people diversify into as well. Again, they're using the Barclays CTA index as a benchmark. And then, of course, they're talking about the risk reduction and performance enhancement. Again, the concept here is that the managed future manager that you would work with, is not going to be directly correlated to like S&P index having to go higher or bonds having to go higher for you to see portfolio advancement. That's the whole concept here. Difference between concept and reality can be very wide, but you have to realize that that's what we're trying to show here is that if you have managed futures and the manager does a good job and he's not connected to the stock market, that it is possible that if the stock market and bond market do turn sour, that the managed account in the futures would have the potential to maybe mellow out some of the performance numbers that might be getting hit because the other two asset classes are getting tagged. But of course, there's no assurance of that occurring. But the concept here is that if they're not correlated directly, it's possible that they would not perform the same way as the stock or bond market. Of course, there's no assurance of that happening, but that's the conceptual thought here. Okay, looking to the next slide here. Amateurs versus professionals. And here I'd like to get into some detail now on some of the people that we've talked about or that I'd like to talk to you about here, where the information will be available to you. Again, amateurs versus professionals. I mean, I've been in this a long time, and I've met a lot of investors. In this day and age, obviously, everyone likes to, not everyone, many people like to do things on their own. They like to trade their own accounts. They like to go to webinars. They like to do the trades. They like to do day trading, weekly trading, all kinds of trading. And some people can do well for a while. Some people don't do well. According to some studies, though, particularly one that was published out of the CME, those with the know-how, time, and access to information, and the temperament, sometimes are highly successful in directing their own accounts. But unfortunately, the record that they see suggests that only a small percentage of it end up coming out on top with it. And so there is sometimes a need for to hire a manager who does it professionally. Again, since I have met so many investors over a long period of time, even when you're doing things on your own, if your portfolio is large enough, it is hard to do everything on your own. That's why people do ETFs. That's why they do mutual funds. That's why they hire managers and hedge fund managers, etc. Because it's hard to be the pilot on every penny that you own. So what you'd like to do, if you could, is to find guys who have a strategy that you think makes sense. Possibly some kind of past performance that shows that they have been performing decently, even though we all know that past performance is not indicative of future results. And, there's no guarantee that what has happened will happen again. You want as much information on what they're doing, who they are, what their charges are, how they get compensated. You want all that. You want all that so that you can make some idea whether these guys fit into your game plan or not. And, many people have different risk tolerances. So, you need information on this stuff before you make any decisions. But, either A, if you're trading on your own, it's very stressful. You might want to off some of your capital to an advisor. If you have enough capital that you think diversifying into this asset class makes some sense. There are people out there who parked all their money when Trump, got elected, and they have heavy cash on the sideline, and maybe they'd want to consider a CTA as a potential person to work with. Or maybe you've been invested fully and this run up has just made your account explode in price, and maybe you want to take something off the table, but you don't want to take it off the table and just go to cash. Maybe you'd want to take some of your risk capital off the table and rotate it into something that is not as correlated to stocks and bonds, and see if any of these guys might be able to work for you. Well, at any rate, this is some of the reasons why people consider them. But before you consider them, you got to get the facts and you got to find out if they're right for you. So, at at High Ridge, we have a large number of, well, I don't know, a large number. We have many trading advisors, okay? And their disclosures and information is available on the website. But I personally have zeroed in on 3 of them. And basically, I'd like to talk about the 3 of them now, briefly. And again, everything we've talked about here is briefly, so it's very important that we do speak to each other after the meeting so you can get more complete details, including the disclosure documents. But let's go over a couple things briefly as we speak. The first person or the first advisor that I've been focused in on is a company called the White River Group. And the manager, his name is Andreas Diesbacher. And one of the reasons I have looked into that manager is because he has a number of strategies, and he's not limited to one strategy only, but he does have two accounts that have to do with stock index option writing. And one of them goes back all the way to 2008, and the other, the dynamic program, goes back to 2014. Now, the reason this is interesting to me, because he is trying to take advantage, if he can, of the time decay of short-term out-of-the-money options. And obviously, there's been a lot of volatility in the markets in the last 8 years, but his performance record here, in my view, has been pretty good. Now, there are a thing called a tear sheet, which has a lot of information on the past performance, which we know is no assurance of future results. So I am referring to the past, and that's exactly what it is, the past. But the two programs that he's got, one is called the stock index option right. It's called the stock index option writing strategy, and the second one is called the dynamic S&P option strategy. And in these two accounts that he's got, these two programs, the one that goes back to 2008, he has had a total return since inception of 157% since inception, and his compounded annual return's been about 12%. And his winning and losing months, 81 months have been winning, 19 have been losing. So that's about an 81% of winning months to losing months. Those of you who are a little bit more savvy on how to compare these guys, his Sharpe ratio in the last for 3 years is 0.46, and his Sterling ratio is 0.33. Now, again, he's using a lot of the E-minis on this, E-mini S&Ps. But, that's a fairly long history. And I think, it is, again, no assurance of future results. And you have to realize this is just past. But it would be something to look into if you were somebody who was interested in the concept of the option writing using the broad-based index as the contract. And again, you get his disclosure document and you look through it and you see if in fact this might be something for you. The other program that he's got is the dynamic S&P option strategy. And on that, his total return since inception, which is about 28 months, has been about 30%. And his winning months to losing months, out of 28 months that the program has been going, 27 months have been positive. Again, this is past performance, past past results. So again, they are not necessarily indicative of future results and should not be read into it any further than that. But that has been what has occurred. And the dynamic program has a few things that are different from the original program. And I think some of the things that are different has been helpful to the dynamic so far, because the winning months to losing months obviously are very dramatically leaning the one way there. But again, that's no assurance that that's going to continue by any means. The other thing that I didn't mention is in the disclosure document, they will go over in much greater detail, more complete detail, a lot of things you need to know about, including the background of the guy, and of course his methodology, and of course any fees and compensation that he gets. But a significant part of the compensation of these guys is a percentage of your profit. It's an incentive on new profits, net new profits, which means that they get a percentage of the account growing. And then if in fact you would have a pullback in equity, the pullback in equity would have to be made up before the net new profit incentive would kick back in. So these guys do have a vested interest in the accounts on many levels, but including that percentage of profit incentive, which can be a significant part of their compensation. And me personally, my opinion is, that's not a bad thing, because, obviously, in my view, it's a positive that there is that shall we say, incentive in their compensation structure. But the tear sheet I'm referring to has much more information, much more complete information, and so does their DDoc. So that's why at the end of the broadcast, we're going to talk about how you can get both of those. But if you're involved in option writing now, and you are interested in somebody who manages money or is a CTA, a commodity trading advisor, doing this type of activity, this would be a guy to take a look at and see if in fact it might be suitable for you. Because again, this manager nor any other manager is right for everybody. So do always keep that in mind. I've been in this business a very long time, and the main thing everybody has to know is that there has to be a balance in everything. And so while this gentleman, in my view, my opinion, has done a very good job in the past, there is no assurance that that's going to continue. Again, that is the White River Group, and again, the two programs, are the stock index option writing strategy, and the second would be the dynamic S&P option strategy, and the manager's name is Andreas Diesbacher. Okay, the second gentleman or second advisor that I've targeted here that I have showed people and find out if they have the suitability and interest in this type of asset class and diversification is named the Pacific Front Capital. And here, this gentleman utilizes proprietary models to generate trade ideas for the relatively short term. And again, he has a tear sheet as well. Again, tear sheet means the past performance numbers and a whole bunch of other numbers, quantitative numbers that you can take a look at. Now, the situation here with this gentleman, his record is not a long-term record, but his record for last year when he initiated his program is impressive. And so to give you an idea, and again, this is all past performance again, but I'm going to read off some numbers here for you off the tear sheet. One is his peak to valley drawdown last year. The largest one that he had here was 9.58%. So less than 10% peak to valley drawdown. His return, average monthly return, was 10.28%. And basically, his cumulative return for last year was 128.45%. Now, he had that spread out through a number of months. And again, his record is not a long-term record, but it is what it is, and he is who he is. And there are some people who are looking for somebody for a more aggressive return. And for those people who are looking for a more aggressive return and are interested in somebody who's trading the contracts more than the options, although he has access to doing a number of different things, this would be a gentleman to get the tear sheet on and to get the disclosure document to see if in fact it might be up your alley, and see if in fact you think there might be merit to his program in your portfolio, again, as a diversification to your assets. Again, it's not right for everybody, but to find out if it's right for you, the tear sheet and the disclosure document are a great place to start. And again, the first gentleman, the White River gentleman, he is working with writing the options generally, but not limited to, and he is working with short-term durations. The gentleman here is working with proprietary models. He's looking for setups, and he's looking to trade the actual contracts, and he's obviously looking for a much more aggressive return, which last year he was fortunate to achieve. But again, last year's last year, this year's this year. But if you look into it and you think it might be right for you, then of course we'd be able to talk further about that. The final gentleman that I've targeted here as an advisor to take a look at only deals with QEPs, which are qualified eligible persons. And so you need to have certain financials in order to qualify to even look at his information. And many of you out there would have this, and many of you may not. So before I would be able to speak or talk to you about this advisor, we would have some document that you'd have to sign off on, indicating that your finances are and experience are of such that you are what they call a qualified eligible person. But for those of you that are, I would love to have you take a look at this gentleman, because I believe he has done a very good job. And again, past performance is not indicative of future results, but I think he's worth a look. So again, those are three guys that I've targeted out of the universe that we have of the excuse me, of the advisors. And again, and some people mix these guys up. In other words, some people put an X amount of dollars of their portfolio into the asset class of managed futures, and then they hire more than one manager and mix them up. Because they don't seem to be very correlated. One guy's working with E-mini S&Ps, the other guy's working with contracts, looking for buy and sell points off of his proprietary models. And then, of course, the QEP gentleman, he's doing whatever he's doing, which we'll get into after, obviously, the qualified people can take a look at that. But again, the purpose of showing you some of the charts was to give you a little bit of an idea that as an asset class, for suitable and appropriate people, this has attracted money. And the evidence right there is on the chart, showing a 771% growth of money coming into this space since 2000, I guess around 2000. So that doesn't mean you belong in there. It just means that qualified, suitable investors have pursued this as part of their asset class. Now, again, hiring a guy who's going to make all the decisions in this space based on his program. Again, the reasoning some people do this is, again, they have assets that are large enough that they want to diversify into something that may not be correlated to the other stuff they're taking a risk on, like real estate, like stock, like bonds, like other things. So they want what could be a non-correlated diversification. Secondly, a lot of them love the fact that these guys are compensated in part by an incentive of profit, so that they have a vested interest in the growth of the money. And of course, if there are losses, as I said, it would affect the computation of the net new profit situation. So these losses obviously would have an effect on them getting compensated. The details on the compensation and all of that is in the disclosure document, and that's why it's imperative that you get that. And you would have to get it, obviously, before you could consider this as an investment anyway. But there are reasonings why people do this. Now, for those people who do decide, hey, I looked at the advisor, I looked at his stuff, I looked at his DDoc, I am, and it's determined you're suitable and qualified to do something like this. If you want to pursue it, again, all the accounts are held at ADM Investor Services, which is a company that has been in business for over 50 years. So the accounts are domiciled at ADM Investor Services. And as far as transparency is concerned, it is very easy to keep track from the standpoint of, you have a portal that you can look through on the internet every day and look at your account. Your positions are your own. This is not a pool. Everybody has their own specific positions, and you can look at yours every single day. And then, of course, you have activity generated statements that can be sent to you. And of course, many people get them by email. So you've got that. If there's activity generated statements, they'll go out to you. And then finally, you do get a monthly statement, of course, to keep track. And then, of course, you can talk to your representative, and you could talk to them directly as well. Now, there is a tax angle to this as well. And for those of you, since it's almost April 15th, you're probably more well aware of taxes than you would be ordinarily thinking about. So let's just go sliding down here to the tax benefit. Let's see if we have that slide. Frequently asked questions. There you go. Are there any tax benefits to investing in the managed futures? And the answer is yes. So those of you who are in higher income tax brackets, this might be something to put into your thinking tank as well. According to the Tax Act of 1981, short-term profits in commodities are treated as 60% long-term and 40% short-term. On the other hand, short-term profits in stocks are treated as 100% short-term, and a short-term investment is one that is held for less than 1 year. And a lot of you guys with stocks are definitely hanging on to these things for a lot less than 1 year, right? So the favorable tax treatment in commodities can translate to investors in the upper tax brackets, saving as much as 30% on taxes in short-term gains on commodities versus stocks. Now, investors and everyone should always consult their tax advisors regarding their individual tax situation, but this might be something to be very, very well aware of when you're making your decision whether you're considering managed futures as an asset class. But again, this is something, information that might be of value to you, so I thought I might put that up, and that might be something you want to keep an eye on as well. So again, if you have any questions on this, it is very easy for you to get more information. And I do want to make sure everybody is aware that there is an offer that I am putting out there for you right now. There's 3 things that you can receive. Again, I'm going to repeat the phone number here at the beginning. My number is 702-873 5707. Again, 702-873-5707. I'm Jim Kinney, and I will be available after the broadcast for a period of time. We did have over, I think it was 150 people registered for this. So if you do get a busy signal, or if it does go to voicemail, please, just leave a message and I'll get back to you as quickly as possible. Be aware of that. And then, of course, I don't get you tonight. Some of you people on the East Coast, it's getting to be 8 p.m. So for those of you on the East Coast, if you leave a message or speak to me first thing in the morning, we can cover this stuff then. But there's 3 things I want you to get. One is, remember the polling question I talked about. How many of you are interested in short-term option writing on the S&P 500 index? How many of you are unsatisfied with your portfolio, or you're satisfied and you want to diversify a bit and you'd be interested in alternative investments? And then, of course, if you want to look at a variety of different markets separate from this, again, the phone number I gave you, you could speak to me directly and let me know what area you might find interesting. But here's the main thing I want to make sure you get, the 2 things right here. I'd like you to get the tear sheets on these managers that I talked about briefly. Why? Because the tear sheets are going to give you the past performance numbers and also a lot of other quantitative analysis. So you can look through this thing month by month and look at it from all the different ratios, Sortino ratios, Sharpe ratios, and all this type of stuff, and get the details on these guys. White River Group and Pacific Front Capital. And those of you who are QEP investors, I can get some details out to you on the gentleman who works with QEPs. And then you can get that in front of you as soon as possible. The last thing, of course, is a copy of a Mastering the Art of Probability. If you're trading on your own, this might be very helpful because it was written by Andreas Diesbacher, who is the manager of the White River Group. And this is free of charge, coming right out to you. It's a piece that he put together called Mastering the Art of Probability. And you guys might want to get that. So again, those are the 3 things that are available. Again, I'll be here for a little bit now, but because of the volume of people that did register tonight, if you do get a busy signal, please leave a message and we'll get back to you either later today or tomorrow, or you can speak to me in the morning first thing. Again, I'm Jim Kinney, and again, the phone number is 702-873-5707. I do want to thank everybody for coming tonight. I hope you learned quite a bit, and it was a pleasure speaking to you. As I always say, good luck and good trading, and I do look forward to speaking to you individually about the things we talked about tonight. Have a good evening, everybody, and again, we'll talk to you soon.